Good morning, and a warm welcome to everybody to today's virtual event. My name is Jose Ordonez, and I am the head of the commercial operation at S&P Global Market Intelligence in Asia Pacific and the developing markets. Thank you for taking the time from your busy schedules to join us virtually today, especially for those who also join us for the first part of the event on September the 9th. Today, we will continue on the theme of this two-part conference, which is Shaping a Resilient Future, Uncovering Opportunities and Mitigating Risks. In my opening remarks on day one, I spoke about how the post-pandemic recovery will be uneven, unequal, and uncharted. Deglobalization has certainly intensified with the COVID-19 pandemic. Against this current economic climate, we'd like to explore how Asia Pacific can prosper as the world that we live in right now becomes less connected. Today, our speakers from S&P Global Market Intelligence and S&P Global Ratings will talk about the extent of credit damage from a COVID-led recession and how COVID-19 will spur the transformation that shapes the future. They will also share their insights on how you can uncover opportunities on the ESG and digital transformation front in order to shape a resilient future for you and your business. So before I introduce our first speaker, I'd like to explain how the conference is set up. Our first speaker will give her presentation, followed by a Q&A session directly afterwards. At any time during the program, you can ask your question by typing it into the Ask a Question box in the lower left-hand side of your screen. To make the presentation full screen, please use the full screen button on the lower right-hand side of the window. After the first presentation, you will be directed back to the selection page to choose a breakout. There are two breakout sessions, and they are integrating ESG to the risk portfolios and identify opportunities, and digital transformation, creating a successful data-driven enterprise. If you have not selected the breakout sessions during your registration, you're still welcome to do it. So with that, let's begin today's program with our first presentation. I'd like to introduce Vera Chaplin, Managing Director, S&P Global Ratings. Today, Vera will talk about the uneven credit impact and recovery from the COVID-19 disruption. Vera, you have the floor.
Hello, everyone. Thank you for joining our event virtually. I'm Vera Chaplin. I'm a lead analytical manager at S&P Global Ratings in Asia Pacific for financial services, government, and structured finance ratings. I'm working from home at the moment, probably like many of you attending this event. So I apologize in advance for any potential technical disruption or noises from other parts of my house. So at S&P Global, we acknowledge that there is a high degree of uncertainty about the rate and speed of the coronavirus spread and when it's likely to peak. As the situation evolves, we are updating our assumptions and ratings accordingly. So as we speak, our colleagues are adding new collections to our numerous published articles. So today, I'd like to cover a few areas for you. The extent of credit impact by the oil and pandemic shock, our assumptions on the shape of recovery and its rating implications, and how we view the digital transformation in some sectors, in particular, banking sector, which really has been accelerated in the present environment. So overall, the impact differ really by geography, by sector, and by issuer. The combination of loss of output and increased debt burdens will continue to threaten corporate solvency. The shape of recovery will differ from previous crises with a wide range of outcomes across industries and geographies. accelerating some secular industry shifts. We see the credit risk is still on the downside with continued uncertainty relating to health outcome, stimulus unwind risk, and heightened international and domestic political risks. The crisis could present an opportunity for government to support the recovery through infrastructure investment, supporting a green, digital, and more sustainable economy. Some sectors and business are also undergoing some major transformation at the moment. So, if you look at some of our published articles for deeper interest, they are available on our website as well as Ratings Direct. Now let me just sort of touch on the credit impact. Unsurprisingly, the abrupt stop to the economic activities have put significant pressures on the credit worthiness around the world. So a few points of observation just in the rated portfolio of corporates and sovereign issuers that I would like to share with you. So firstly, our observation is that the default is on the rise, and we're expecting more to come from the low speculative grade issuers. So as of August 12th, the global default tally is at 155, and we do expect this to continue to increase. The default is led by oil and gas sector, and followed by consumer products and media and entertainment, and predominantly from the US. And the other point to note with the default is so far over 90% of defaults are from the CCC rating category, which is the lowest rating levels on our rating scale. It is worth noting, in the present lower for longer interest rate environment, it has fueled demand for riskier assets, enabling low spec grade issuers to access funding. This is particularly the case in the US and Europe, where we actually have seen market increase in single B and lower issuers as a share of the total ratings population. Since 2008, we have actually seen this category rising from 24% to 33% in the US and from 6 to 25% in Europe between 2008 and 2019. So the rest of the world, on the other hand, really remained range bound with about 15% of the rated portfolio at this riskier end. These credits are far more vulnerable to adverse changes to economic and financing conditions, even with the government support measures, and some of these issuers may not make through the cycle. So the second observation I want to share is with respect to our rating actions. So some observations we have is that our rating downgrades so far are also mainly from the spec grade, non-financial corporates. Historical rating performance show that the lower rated issuers do face faster credit deterioration and substantially higher default risk than their higher rated counterparts. This is in line with our ratings definition. So with the economic shock of this magnitude, the number of rating actions are considered to be moderate. I think this is largely because there's some extraordinarily large monetary and fiscal measures coupled with the supportive approach by banking sector have provided some cushion, and of course the market liquidity have returned to orderly operation. Still, so far, COVID-19 has triggered close to 40% of rating action, which include 20% of the corporate rating and sovereign rating portfolio have experienced downgrade rating actions. Now, 87% of these rating downgrades were mainly on the non-financial corporates, concentrated in weaker credits to start with, and in most affected sectors. And over 80% of these rating downgrades are in the spec grade on the BB and lower rating category, or otherwise, again, the market knows it is the spec grade ratings. So looking forward, which is the third point I'd like to make, is the negative bias of the portfolio have increased, and this is still firmly on the downside, and it really depends on the shape of recovery, which I would like to cover a little later on. And so looking at the negative bias, currently we still have over 5% of the rated portfolio going through credit watch resolution in the next 90 days. And then there's 13% of the ratings are on negative outlook, which reflect the future bias. So the longer the negative environment persists, the higher the downgrade risk, and higher the potential risk of the spillover effect. We could expect a prolonged economic contraction to cause heavy credit erosion, especially among those in the lower rated issuers, who will continue to suffer from poorer earnings, difficulties in managing the cost structure, and for weakest link issuers, still limited funding opportunities. It could also, lead to further spillover effect, as mentioned before, to other sectors, such as the banking sector, and then some structured finance ratings that actually depend on, the performance from corporates and households, etc. So now let's take a look at some stats. And I will try to put some context around it. So if we have a look at, the weakest link measures, these are the measures where we actually assign the rating at a single B level, and they are currently on credit watch negative or outlook negative. So we use this as a leading indicator for default. So if we look at the figures here, firstly, if you notice that the red line, which represent the number of single B minus or lower rated issuers with negative outlook and credit watch, the total number of the weakest link, have peaked at 611 in June before decreasing to below 600 in more recent times. This is more than double the numbers in 2009. It's now about 18% of the rated portfolio. Now, historically, the reason I want to highlight this is because historically, the default rate amongst weakest link is about 30%, and it is 8 times higher than the default of spec grade issuers, which sits at about 3.4%. This is so you can see that this is a fairly significant risk, and the levels we have now is actually really does signal more default to come, and it's likely to exceed the 2009 levels. And if I point to the pie chart, 74% the weakest links are in the US, and 17% in Europe. APAC has only 5%. US certainly takes a lead on the default tally with 102, and Europe with 22. Now, this in part reflects that US has a deeper capital markets, and as mentioned earlier, some of the recent developments in the access by issuers with the weaker credit profiles. And then thirdly, if we look at the chart on the right, this shows the weakest link distribution by sector. about 50% of the weakest links are in the top 5 sectors. So this includes media, entertainment, consumer products, oil and gas, capital goods, and retail and restaurants. So if we look at the yellow line, which represent number of defaults today, the highest number of defaults are also in these sectors, apart from the capital goods. And if we take a look at the ratings by geography and industry, I've classified them into 4 major categories: non-financial corporates, financial institutions, insurance, and sovereign. A few observations here. The non-financial corporates certainly takes the lion's share of the rating actions. And if you look at the pie chart on the left, the blue section does show that US has the biggest share of that. Financial institutions, which follows, but certainly by much lower number. But the bar chart, as you can see, is mainly concentrated on the outlook changes. And, EMEA is actually dominating this area. Insurance has the lowest level of lower rating actions, and again, predominantly is a changing in outlook. So if we look at rating impact by sector, non-financial corporate was hit first and represent nearly 90% of the downgrades and the potential downgrade actions. So at the sector level, we can see the highest level of rating downgrades in energy, retail, consumer, media and entertainment, consumer products, and transportation. So with close to 25% negative outlook, the pressure on financial institutions will be really felt down the road. We expect lenders to be hit hard over the next couple of years, and we expect asset quality will weaken and earnings will fall. Banks' ratings have been fairly resilient so far, with limited downgrades. 75% of the ratings are still on stable outlook. But the risk is on the downside as long as there is uncertainty with the health outcome, as many countries are still struggling to control the outbreak. In APAC, government monetary, fiscal, and prudential support are providing buffer in the region. In addition, the banks in many countries benefit from strong earnings capacity compared to some of other, their European counterparts. So we do expect most banking system in the region to stage full recovery by 2023. And further, we expect systemically important banks likely to receive timely government support. So, we did mention shape of recovery is going to be a key determinant. So let's take a look at the shape of recovery on this slide. I'd like to point you to also an article we published called the COVID-19 heat map. Post-crisis credit recovery could take to 2022 and beyond for some sectors. This article really sets out by region and by sector our view on how the sectors will recover amongst the corporates. It's got about 40 industry trends update and the recovery prospect or what could derail them. So we do expect the road to recovery for Asia-Pacific GDP trends and earnings will stretch to 2023. And for most sectors, we actually expect the operating conditions and credit metrics to recover to 2019 levels in the second half of 2021 or 2022, given the demand shock created by the pandemic. For some others, this actually could stretch to 2023 and even beyond. And so as mentioned earlier, we definitely acknowledge there is a lot of uncertainties around the evolution of the coronavirus pandemic. The consensus amongst health experts is that the pandemic is at or near its peak in some regions, even though we see some countries still struggling. It will remain a threat until vaccine or effective treatment is widely available. It may not occur until second half of 2021, which is the consensus. We are using this assumption in assessing the economic and credit implications with the pandemic. And as the situation evolves, we will be updating our assumptions and estimates accordingly, which may or may not impact the rating. So there's a few things that determine the shape of recovery. And firstly, looking at the non-financial corporate issuance, it has been massive to date. So while revenue may not recover, the full credit metrics may take longer to actually recover for the harder hit sectors as a result of these larger debt levels. There are other industry sectors such as travel and leisure, businesses that require interaction may not even return to their prior year's revenue for several years to come. Airlines probably is one of them people probably can relate to. So new normal will most likely look very different. The way we work, the way we shop going forward. This could lead to more permanent changes for some business sectors. We can imagine the shopping malls and some of the office environments. The financial policies may shift for the companies going forward. We might assume that companies want to return to their financial metrics pre-COVID-19, but they might actually prefer to hold their debt for longer. So if we look at this slide, we expect the essential retail and telecoms are the first to rebound. Oil and gas and auto will be the last. And real estate, capital goods and others are somewhere in between. So I guess thanks mainly to the government and regulatory actions, the financing conditions have eased compared with in the last in late Q1 and early Q2. However, the financial conditions for the high yields are likely to remain, especially the lower rated high yields, likely to remain difficult and expensive regionally. And geographically, China leads and followed by developed economies with emerging markets last. In APAC, COVID and oil price decline have triggered so negative reactions for over a third of our regional pool. So indeed, the negative rating outlook buyers comprise 1/6 of the issuer rating. So it's a fairly large hit. Whilst we're seeing some green shoots signaling regional recovery, the likelihood of rating downgrades and defaults still persists due to the uncertainty. Some of the top risks that we are seeing is the build-up of leverage, economic disruption from COVID measures, spillover effect with some of the US-China strategic confrontation and potentially uneven access to US dollar funding. So if we take a look at this on the slide, I think I will just pass on that one. So in the region, I did mention the emerging market will recover a little bit slower, and I think India and Indonesia maybe is, as people are observing, probably haven't yet peaked. And some of the policy stimulus could also vary between different governments due to their capacity to support. So over the if you take a look at this particular slide, we're actually seeing that I think I've already touched on it. The timeline for different industries, when we expect 2021 recovery, 2022, and 2023. So if you have an opportunity, feel free to have a closer look at that. And now I wanted to touch briefly just on some green shoots that we're talking about. That many digital transformation are taking place. If we just think about the online shopping and also different ways that different businesses are trying to deliver services to the consumers due to the social distancing. Of the past 12 months, we certainly have published numerous articles, I think maybe up to 19 now across the banking systems, looking at the digital disruption, particularly in the retail banking area. These are available on our webpage. If you look under Future of Banking. More recently, we have published also commentaries on Singapore, Hong Kong, Australia, Taiwan, South Korea, and Russia. So if we look at the disruption on this chart, as you can see, we've divided into 4 dimensions how we look at it. From the technology perspective, from regulation, industry, and customer services. We chose this category so we can group it as an acronym of TRIP. So we call it the TRIP analysis framework. So despite the COVID-19, so behind the scene, the fintech has become even more important for banks. It actually helps to differentiate those who actually can perform better during the crisis. And this, the current focus due to the COVID disruption is no longer on how to attract customers to digital channels, because customers actually turning to digital channels out of necessity. The dialogue is about who has the technology capabilities to actually service the needs of the customers digitally from end to end. So we actually have seen an acceleration in digital banking due to COVID and customer service or customer preference changes. The implication of this is that banks with less digital capabilities would potentially actually face loss of revenue if they cannot service their customers' needs digitally. Some example would be some of the complex product traditionally where you need face-to-face interaction. These can, now being replaced with virtual interaction. So those ones who are geared to shift to that are servicing their customers well. Many banks actually have seen a surge in digital apps downloads, traffic and transactions done through mobile or online banking channels. We have seen a range between 40 to 100% increase in digital banking usage in the last few months. I guess looking at these developments, one could think that there is a longer-term pattern building. We could be expecting to see faster transition to digital banking model and more permanent changes. And for some countries, this would mean more, that the branches could reduce in numbers and more quickly than we originally anticipated, and the banks could rapidly move towards high value added services. We also have seen increasing contactless payment as people are concerned with the virus transmission from handling of cash money. So if you just look at some stats from MasterCards, etc., with the increase in utilization, you will get a feel. And from regulatory front, we've seen some regulators becoming more flexible and less resistant in removing certain regulations to facilitate transactions to be done on the online channels. So, for example, some more sophisticated products such as insurance products that are now required to be sold to to clients face-to-face, traditionally moving towards more online approach. So we have published numerous articles, as mentioned, so feel free to actually take a look at them and see whether if you would like to explore any area a little bit deeper. Certainly, amongst the ones we have published, Singapore, Hong Kong, Australia, Korea, Taiwan, we certainly found Hong Kong, Singapore tend to have similar characteristics in their fintech development, except for regulators have taken a more forceful approach in the fintech development for Hong Kong, and Australia is actually now catching up with the open banking. After a period of delay, they are now catching up to their peers in UK, Sweden, and China due to very strong preferences of customer adoption. So I think overall, I might just pause here and see if anyone has any questions for me. Thank you.
Thank you very much, Vera. So we're now going to take some questions from the audience. And the first one that came in was, you mentioned that the default rate is on the rise still. What is the likely peak default rate?
So thank you, Anna, for that question. So as we know, there's still a lot of uncertainties. So there is a wide range of possibilities in health and economic outcome, which makes it more difficult to forecast. Given that 2/3 of default from our rated portfolio are from US, maybe I use US as an example to start with. So our research colleagues in US have been forecasting or estimating US spec grade 12 months trailing average of default, and they estimate that this will reach a 12.5% by June 2021. And this is based on the base case economic forecast, which I have mentioned. So what we have noticed, though, is that there is divergence between the market expectations and credit and economic fundamentals. So based on the market pricing in the fixed income space, even with the weaker credits, it's actually indicating the default probably would be not too much more than 4%, which is rather optimistic. The possibility is because there is a market optimism in Fed's liquidity facility, upside possibility with vaccine, and belief in further lockdown that could be accompanied by further monetary and fiscal stimulus. So I guess. Based on that, there's still a very big discrepancy. However, on the downside, as I mentioned, if the recovery is not as expected as our base case, we could actually think it's going to go beyond our base case of 12.5%, may even reach 15.5% in the more pessimistic scenario. So while the monetary and fiscal policies are supportive in the near term, the growing burden amid falling revenue could lead to some protracted period of high default rather than the typical cyclical behavior. So Anna, while we're on that, I noticed there is another question that sort of is relating to what are the tension and credit implication from escalating risk, maybe from US election, climate change, etc. So there are many other factors. It's a fantastic question, and we would agree that there are multiple other factors are also escalating and worth monitoring. So you probably will have a ESG presentation later on, but let me just talk a little bit about the environmental, social, and governance risk in ratings. A lot of people probably are more familiar with the governance component being, heavily discussed in the ratings, probably less so thinking about the environmental, such as climate change or social factors. And we actually consider COVID-19 impact one of the social factors. Some of the credit that credit ratings were adjusted are actually direct impact of COVID-19, such as, for example, the aeroplanes cannot fly, etc. So we actually have been actively disclosing this in our ratings. And then, please follow on that. We do see that there's a lot more discussion in this space and disclosure in this space on the ratings. And on the, US election, so what we're probably more closely monitoring is the US-China tension, which is listed as one of our top risks to monitor for the credit conditions. The current risk for US-China tension on our scale is high. The next level is very high. And in terms of the trend, we have just revised it to worsening. And this is really in consideration of, more recent tension being escalating, and including, potentially the sanctions that's coming through currently. What's being announced through the executive order has no direct flow-on impact yet, but we're closely monitoring, what the HKAA can actually come through and impact us. So on the credit side, we are receiving a lot of questions from investors, and hopefully we will be able to share more comprehensive thoughts on this matter soon. Thank you, Anna.
Thank you very much, Vera. So I think we have time for one more quick question, and that is, do you see pressure on creditworthiness easing with some signs of recovery?
Yes, we are seeing some easing. I did paint some of the downside risk, and certainly the downside risk is persisting because of the uncertainty. We're seeing the pressure easing, as mentioned. The number of rating actions have reduced already since April, and the number of new rating actions is declining. And then the other side, as mentioned, in the weakest link portfolio, that is the single B minus and below with negative bias, that peaked at 611 and dropped to, in the 500s. And also the other thing that we do monitor is fallen angels. So some people do ask that question. This is where ratings that would actually impact some of the investment grade credits. It's a very small percentage at the moment, but there are globally about 40 credits have fallen from BBB minus to below to the spec grades in the first 7 months. And we are closely monitoring the potential fallen angels, which is the BBB minus with negative bias, whether if it's credit watch or outlook. Now, so I mentioned that because the number of the potential fallen angels is now at 120, which has fallen from the 126, which was the peak. And also that the number of credit watch negative in that space now is only at 13% compared to the 27% that we had before. So the rest are in the outlook negative space. What this would mean is that that it will allow more time for the economy to recover, for the revenue prospect to improve, and potentially resulting in more stabilizing effect rather than the continuous credit degradation for these issuers. So overall, the short-term risk decline is visible, but the longer term continue to present uncertainty, and therefore longer-term risk loom. and therefore the path of recovery is extremely important. Here we're talking about the rated space, but I think if we also consider the small medium enterprises and the households who are under pressure currently receiving various government support, we are also closely monitoring the impact of that once some of these supports start to consider their way of unwinding if hopefully vaccine will become more readily available. Thank you.
Thank you very much, Vera. So we're now going to move on to the breakout sessions. We've got one, as Vera mentioned earlier, on ESG and another on digital transformation. Thank you.
Thank you.